September 12, 2025. A 74-page crypto market structure bill passes the U.S. House of Representatives with bipartisan support. Republicans vote yes. Democrats vote yes. Committee leadership endorses it. Floor speeches describe it as overdue. The bill does something simple and unprecedented. It allows crypto platforms to pay interest on dollars without being banks. By January 29, 2026, that same bill has not received a single procedural vote in the U.S. Senate. No markup, no amendment package, no scheduling notice. At the same time, the text of the bill remains unchanged. It explicitly authorizes crypto platforms to distribute yield to retail holders of dollar-backed stablecoins, an activity banks are legally restricted from performing without a banking license. A law written to clarify market structure quietly authorizes a core banking function outside the banking system. That contradiction is not accidental. This is Unblocked Crypto, where we decode who crypto systems really work for. In late January 2026, U.S. financial headlines converge on the same point. Banking associations issue statements. Industry lobbyists escalate warnings. Opinion columns frame the moment as a regulatory showdown. The target is the Clarity Act. Not because of volatility, not because of token speculation, not because of retail protection failures, but because of interest. Specifically, because the bill permits stablecoin issuers and crypto platforms to distribute yield generated from reserve assets directly to individual users. That matters because paying interest on dollar-denominated instruments has, for more than a century, defined the legal boundary between banks and non-banks. On screen, the Senate calendar appears. The bill is listed, referred to committee, then frozen, not rejected, not amended, not debated. It simply stops moving. Outside Congress, reactions accelerate. Financial media simplifies the conflict. Banks versus crypto. Old finance versus new finance. That framing is convenient. It is also incomplete. This is not about crypto challenging banks. It is about who is legally allowed to perform banking functions. At this point, something shifts, because the Clarity Act does not legalize speculation. It legalizes yield. Under the bill, payment stablecoins are defined as dollar-linked instruments backed by cash and short-term U.S. treasuries. Those reserves already generate interest. The bill allows that yield to be passed through to users. Visually, treasury bills accumulate yield. Stablecoin reserves sit on balance sheets. Smart contracts distribute returns. The bank is not part of the loop. This is where most people stop looking. They see modernization. They see fintech efficiency. They see competition framed as consumer benefit, but system behavior tells a different story. Banks pay interest under constraint. Deposits are liabilities. Liabilities require capital. Capital limits leverage. Liquidity rules restrict withdrawal velocity. Resolution regimes impose failure costs. Every dollar of bank interest exists inside a dense regulatory shell. Stablecoin issuers do not operate inside that shell. They do not lend deposits. They do not transform maturities. They hold short-duration assets. They pass yield mechanically. On screen, a split comparison. Left side, a commercial bank balance sheet. Deposits, loans, risk-weighted assets, capital ratios. Right side, a stablecoin reserve structure, treasuries, cash equivalents. No lending book, no credit creation. Both earn yield. Only one is treated as a bank. The Clarity Act does not correct this asymmetry. It formalizes it. It does not require stablecoin issuers to obtain banking charters. It does not impose deposit insurance. It does not prohibit interest distribution. It classifies stablecoins as market instruments rather than deposits. This is not accidental language. It is the bill's architectural core. And here is the part that rarely makes the headlines. This structure favors very specific actors. It favors platforms large enough to custody billions in treasuries. It favors issuers capable of navigating market regulation without bank supervision. It favors entities that can earn yield at scale, without balance sheet risk. It does not favor small banks. It does not favor regional lenders. It does not favor institutions whose business depends on deposits staying put. Why would lawmakers allow this? The answer is not ideological alignment with crypto. It is jurisdictional convenience. In the United States, banking law and market law are separated. Bank regulators govern institutions. Market regulators govern instruments. Stablecoins sit between those domains. The Clarity Act pushes them firmly into the market category. Once that decision is made, everything downstream becomes automatic. At this point, something changes again. Because interest changes user behavior. Yield transforms stablecoins from payment rails into cash substitutes. This is where banks react, not because crypto is volatile, not because blockchains are untested, because deposits are sensitive. Even small shifts matter. Deposits fund lending. Lending funds consumption and investment. Outflows tighten credit conditions. This relationship is mechanical. No ideology required. When banks lobby against the Clarity Act, they are not defending tradition. They are defending balance sheet stability. They are defending the role of deposits as the default resting place for dollars. Here is the detail rarely stated publicly. The Senate did not stall the bill because it is unclear. It stalled because it is too clear. If passed as written, the Clarity Act establishes a legal precedent. Dollar yield can exist outside the banking system. Once that precedent exists, it cannot be quietly reversed. This explains the institutional divergence. The House responds to innovation narratives and constituency pressure. The Senate absorbs systemic risk and institutional impact. Different incentives, different time horizons. This is the structural reality. Crypto legislation rarely collapses publicly. It stalls quietly at jurisdictional fault lines. Zoom out further. This episode is not fundamentally about crypto. It is about the definition of banking in a digitized dollar system. For more than a century, the rule was simple. If you pay interest on dollars, you are a bank. The Clarity Act challenges that rule, not by confronting it, but by bypassing it. That is why the bill is stuck. Not because lawmakers don't understand the implications, but because they do. So the unresolved question remains. If interest on dollars no longer requires a bank, what exactly is a bank for?